Hi guys, in today's video I wanted to take a quick look at 5 potential warning signs that a company might go bust. Of course, these are not the be all and end all. There are many signs and sometimes these things are completely innocent, so take this with a pinch of salt, but it is worth knowing how to read company accounts and what to watch out for in terms of red flags. If you want more detail around any of this, then I really recommend this book, The Signs Were There by Tim Steer. It is really good, and I will link it down below if you are interested in a more detailed account of any of this. The premise of the book is that a lot of the company collapses that have happened recently could have been predicted by the company accounts. So it is really interesting to dive in and have a look at the kind of things that could be clues as to what's going on in the company. There's also a quote in the book that I absolutely love, and it says, "A company's accounts should be seen as an iceberg in terms of the information it contains. It cannot tell you all that you need to know about a company, but if there is something in it that makes you feel uneasy, there may well be other, even more uncomfortable things lying below the metaphorical waterline." So if you are an investor in individual stocks, it is worth knowing what to watch out for. So the first potential warning sign that a company might go bust is large amounts of accrued income. Remember, accrued income is not income that you have invoiced for. It is just a forecast of what you are owed. If on a company's accounts you have accrued income of 50 million, but profits reported only 20 million, that essentially means that without that accrued income, the company would be reporting a big loss. Accrued income is seen as a low quality asset because there is no guarantee that they will get that money. And it's especially worth investigating in software companies because software is essentially pure profit. Large amounts of accrued income can actually also mean poor cash flow, which is one of the top reasons that firms go bust. An example of this is Carillion. Now, you've probably heard of this because it was fairly recent and it was all over the news when Carillion collapsed. But when we look at their accounts, in 2016, their sales rose by 14%, but the amounts owed to them rose by 46%. That should have been a huge warning sign. The second thing to potentially watch out for is big increases in capitalized costs, especially internally generated ones. This could be a sign that earnings are being overstated and probably on purpose. You see, capitalizing costs means that they don't hit the profit and loss account, they just go straight to the balance sheet. They then get written off over a set period of time, which is usually determined by the company, and that's when they hit the profit and loss account. This happened in a company called Connaught, which went bust in 2010. Now, in their 2009 accounts, it was quite clear that there was a big increase in capitalized costs. Now, they began getting lots more complicated contracts that they couldn't keep up with, which required more investment, and the investment that it required was hitting their cash flow hard. So what they did was they capitalized these costs and therefore made them avoid the profit and loss account. And it was really clear in their accounts in 2009 that they had done this, and they had notes about internally generated software being capitalized. Now, whilst this in itself is fine, it's perfectly fine to account for software in that way, but what happened was they were capitalizing a lot of costs that didn't make sense. So again, essentially a red flag to then go down the rabbit hole and find out more. Now, talking of red flags and the things that are just worth investigating more and keeping an eye on, the third thing is large intangibles. Intangibles are very subjective in nature, and so if it's one of the biggest numbers in the accounts, it is really worth investigating. Seeing what the reasoning is behind these intangibles, how they were calculated, and whether you think that that's a sensible way of calculating the intangibles. The fourth thing to look at is valuation of inventory. Now, there are accounting standards which tell you how to value inventory, and it should be, I believe, at lower of cost or net realizable value. But essentially what you have to remember is that 1 year's closing stock is next year's opening stock. And if you have a low value of your opening stock, then any stock you sell in that year will give you a much bigger profit. Now, a brilliant example here is Sports Direct, everyone's favorite company. If we look at their accounts, they had an unusually large write-down of inventory in the year before the IPO. Funnily enough, this led to exaggerated profits just in time for their IPO. Now, this became apparent very quickly when the next round of profits came up, and it was very clear that the previous estimates were completely exaggerated, and Sports Direct lost about 90% of its value then and took years to recover. Now remember, this isn't an exhaustive list, but the fifth and final thing for this video is big insider selling. Now, insider selling in itself isn't a bad thing. You know, over the normal course of business, insiders will sell their shares. If a stock is doing well, they may just want to cash in on the profits that they've made. But what you want to look out for is unusually large or frequent sell-offs, or sell-offs around the time that bad news starts to come out about the company. Big executive holders of shares typically dump their shares just before they file for bankruptcy, or something big is going to happen that they know will have a big impact on the share price. An example of this is Connaught, again, the company we mentioned earlier. In January of 2010, their CEO departed suddenly after selling 5.5 million of his shares. They went bankrupt later that year. So that's it for today's video, guys. Hopefully this has been educational and interesting. Let me know what you think. I'm happy to do more videos like this. But yeah, have a great week and I'll see you in the next video. Bye.